Welcome back to the deep dive. Today we're tackling something absolutely critical in business and economics: how companies actually achieve, value creating growth.
Right.
It sounds simple, doesn't it? Just grow. But the reality, as our source material for this deep dive makes clear, is, well, anything but simple.
That's absolutely right. The research we're diving into really highlights just how challenging growth has become,
Yeah.
especially since the global financial crisis.
Yeah.
It shows corporate growth slowed down significantly and just, throwing more capital at the problem.
Yeah.
That hasn't been the guaranteed fix it maybe once seemed.
So if the old ways aren't working quite as well, what does drive that value creating growth now?
Yeah.
Our deep dive today is built on some serious empirical research. I mean, a huge study.
That's massive.
Looking at the world's 5,000 largest public companies over 15 years. So our mission is to unpack this data, understand what it says actually works, and pull out the maybe surprising facts and actionable insights. They call them the 10 rules of growth.
And the research starts by confirming something pretty basic but important.
Yeah.
Yes, revenue growth is profoundly important.
Okay.
It's a key driver of overall corporate performance and, crucially, total shareholder return, TSR, which we'll probably mention a lot.
Great, TSR.
The study found this really powerful correlation. Get an extra 5 percentage points of revenue growth per year, and that tends to line up with 3 to 4 percentage points of additional TSR. That's, pretty significant.
Okay, so growth definitely matters for shareholder value. Big time. But you said it's hard. Just how hard did the research find it to be?
The numbers are pretty stark, actually. Looking at those 5,000 companies over 15 years, the median growth rate, only 2.8% annually.
Wow, median 2.8%.
Yeah, and it slowed down even more after COVID hit. But what's really telling is only 1 in 8 companies in the whole sample managed to get growth rates above 10% per year.
Only 1 in 8.
1 in 8. And it also showed that companies relying mostly on organic growth, building from within, they actually grew slower on average than companies using more inorganic growth, like M&A.
Interesting.
So, yeah, sustaining healthy growth is clearly a major challenge.
1 in 8 clearing 10%. That really hits home how tough it is. So this huge study nails down 10 rules that seem to separate the winners from the others. But you also hinted they're hard to follow.
They really are. The research found fewer than half the companies actually mastered more than 5 of these 10 rules.
Less than got half the rules right.
Exactly. And get this, only 8% mastered all 10, a tiny fraction.
8%. Wow.
It really suggests these rules aren't obvious, or maybe they're just very difficult to implement consistently.
Okay, let's unpack this then. If these 10 rules are the empirical blueprint for value-creating growth, and hardly anyone masters them, understanding what they are and why they work seems vital. For anyone interested in, how the economy really ticks, where do we start? What's rule number 1?
Rule number 1 is fundamental. It really sets the stage. Put competitive advantage first.
So it's not just about chasing revenue growth no matter what.
Precisely. The research really emphasizes that sustainable value-creating growth has to be built on a strong foundation. And a key indicator of that foundation, high return on invested capital, or ROIC.
ROIC, right.
Companies with high ROIC show they have a strong business model, a real competitive edge that lets them make profits efficiently from the money they invest.
And how does that link to growth? Why does putting that advantage first actually enable growth?
Well, because companies generating stronger returns, higher ROIC, they're more attractive to investors, right? So capital is easier to get.
Makes sense.
But maybe more importantly, they can effectively cycle those profits back into the business, investing in R&D, new markets, expanding capacity.
Yeah.
That lets them grow faster, but also more profitably, more sustainably. They're growing value, not just size.
Got it. Build a strong, profitable base first. The source had a good example of this, didn't it? A department store.
Yeah, that department store chain example from 2007. They weren't initially super high ROIC, maybe around 5%,
Go.
but they focused on the fundamentals. Brand name bargains, better inventory management, and they pushed their ROIC up to 8%.
Right.
That improved profitability. It gave them the financial muscle and, frankly, the confidence to invest heavily in expanding their stores. They went from about 900 locations to over 1,500.
Big jump.
Huge jump. And this investment, fueled by that healthier core business, drove revenue growth of 8% a year. This is key. Earnings per share grew 29% annually.
29%.
Yeah. It shows really clearly how improving the core business health is the engine for effective growth investment.
That makes perfect sense. Need a healthy engine before you hit the gas. Okay, so that's rule one. What's rule number two?
Rule number 2, make the trend your friend.
Okay, this sounds like looking at the big picture, riding the big market waves.
Exactly. This rule suggests strategically positioning your business to benefit from those large-scale, long-term trends. Think about global shifts like aging populations, the energy transition, digitization everywhere, new consumer classes in emerging markets, that kind of thing.
It sounds like classic business advice, really.
It is. It's age-old wisdom. But the research provides some hard numbers showing it still really, really works.
And the data confirms that latching onto these big trends actually pays off in terms of returns.
Absolutely. The study found that companies which successfully expanded into areas that, increase their exposure to these fast-growing, often more profitable market segments, they generated 1 to 2 percentage points of additional excess TSR
1 to 2 points extra just from that.
annually over the 15-year study period. So it wasn't just theory. It translated directly into better shareholder returns compared to peers who did make similar moves.
So connecting your strategy to those big forces isn't optional, it's essential.
That's what the data suggests.
Okay, identify the big waves, figure out how to surf them. But what if you're in an industry that isn't growing fast? Or maybe you're just not keeping up with competitors.
Well, that leads us perfectly into rule number 3. Don't be a laggard.
Okay. What happens to companies that fall behind their industry peers?
The research is pretty blunt here. Outgrowing your industry median is critical, absolutely critical for creating value and beating the market.
Right.
Companies that consistently grew faster than their industry peers were significantly more likely to beat market expectations and deliver those higher shareholder returns.
So even if your whole industry is kind of slow, you still have to be faster than the average company in it.
Exactly. The data shows that getting, say, 5 percentage points of annual shareholder returns above your peers, that often requires growing faster than the industry median growth rate.
Otherwise, you're falling behind relatively.
Right. If you're growing at 5%, but your industry is growing at 10%, you're probably losing ground in terms of value compared to the leaders in your sector.
Did the source give contrasting examples for this one?
Yeah, 2 really clear ones. There was an apparel company growing at 4% annually, but its sector grew way faster, like 17%.
Ouch.
Yeah, they lagged their peers significantly in TSR. But then contrast that with a home improvement retailer. They grew at a strong 17% annually, while their sector only grew at 3%.
Big difference.
Huge outperformance. The message is crystal clear. Relative growth matters. A lot.
It really clicks. It's like, yeah, a rising tide lifts all boats, but you still need to be paddling faster than the boat next to you to actually get ahead.
Okay.
Okay, so where does this growth usually come from within a company? Rule 4.
Rule number 4 is supercharge your core.
Focus on your existing main business.
Right. When you actually look at where the revenue growth materializes for these big companies, the core business is like overwhelmingly the largest source.
Okay.
The research analyzed growth coming from core industries, secondary industries where maybe they have a smaller presence, and then totally new industries.
And what did they find about how much comes from the core?
On average, a really substantial 83% of a company's revenue growth over those 15 years came from activities right within their core industry. It's the engine room.
83%. But wait, you just said in Rule 3 that outgrowing your peers within that core industry is hard.
It is. And that's kind of the paradox the research highlights. The core is where most growth comes from, yes. But achieving above average growth within that core is really tough because, well, everyone's fighting fiercely in the same space.
Right, it's competitive. The source had a chart showing how that core contribution varied by sector, didn't it?
Yes, exactly. And it showed quite a range. While the average was 83% from the core, some sectors like utilities actually saw their core revenue shrink minus 16%.
Wow.
But in really fast-growing areas like healthcare, 91% from core, and IT, 86% from core, the core was even more dominant as the growth driver.
So regardless of the sector, the core is the undeniable starting point for most growth strategies.
Absolutely, even if outperforming within it is a challenge.
Okay, so the core is dominant but super competitive. If growing that core much faster than peers is difficult, where else should companies be looking?
And that takes us straight to rule number 5. Look beyond the core.
So growth isn't only in the core. There's potential elsewhere.
Not entirely, no. While that 83% came from the core on average, The research also tracked growth from expanding into adjacent industries or sometimes even entirely new ones.
Okay.
The study found that on average about 80% of growth came from the core or these adjacent new industries combined.
Hold on. 83% from core alone, but then 80% from core plus adjacencies in new areas. How does that math work? It sounds a bit off.
Yeah, good catch. It sounds confusing. To
Yeah.
clarify, the 83% figure is the average contribution from the core for companies based on their initial industry footprint.
Right.
The 80% figure represents the actual observed growth source distribution across the sample, including companies that did diversify. So growth from those adjacencies and new areas contributed, slightly shifting the overall average composition away from being purely core-driven for the entire sample.
Okay, so the 80% reflects the real-world mix where companies are looking beyond the core somewhat.
Exactly. The source mentions that if industries had fully captured growth in areas distinct from their core, that 80% might look different. The main point is there's significant growth potential sitting just outside the strict definition of the core business.
Ah, okay, that makes more sense. It's about where growth can and does come from in practice. Was
Mhm.
there an example of a company doing this well, looking beyond the core?
Yes, they highlighted a global automotive parts supplier. They didn't just, stick to traditional car parts.
Right.
They strategically moved into related areas, things like bike systems, safety systems, powertrains.
Stuff where they could use existing skills.
Precisely. These were adjacent segments where they could leverage their existing manufacturing know-how, their engineering, their supply chains. About 75% of their growth came from this mix of core and smart adjacent moves.
And it worked.
Yeah, they grew significantly faster than their peers, 2.4 percentage points per year faster.
That auto parts example really highlights something important, though. They moved into related areas. It wasn't like a random jump into something completely different.
Absolutely. They weren't suddenly making, breakfast cereal.
Which brings us neatly to the next rule, doesn't it?
It does. Building right on that idea, rule number 6 is grow where you know.
Okay, so the research found it actually matters how similar those new areas are when you expand.
It matters profoundly, at least for value creation. The study found that diversifying into similar adjacent segments is substantially more effective than, say, venturing into dissimilar ones that have little connection to your core capabilities or markets.
And there's data to back that intuition up, like actual numbers.
Strong data. The research found companies that successfully entered similar adjacencies gained 2.0 percentage points higher excess total shareholder returns
2 percentage points higher TSR.
compared to those that tried to enter non-similar adjacencies. 2 points of extra TSR just by picking a related field, that's a huge difference over time.
Wow, yeah, 2 points based just on similarity. Why do you think that is? What allows that extra value? Is it just easier?
Well, the source points directly to synergies. When you enter a similar business, you can often leverage what you already have. Your assets, capabilities, customer relationships, purchasing power, manufacturing expertise, distribution networks.
You don't have to reinvent the wheel.
Exactly. You're not starting from scratch. They use the classic example of General Mills buying Pillsbury.
Right.
Because there was so much overlap products, manufacturing, distribution, even procurement complexities they managed, General Mills could achieve massive cost reductions.
How massive.
The source notes they significantly cut costs in purchasing, manufacturing, distribution, raising operating profit by roughly 70% in the combined business.
70%. Okay, that's a very concrete example of value from similarity.
Definitely shows the power of synergies.
Okay, leveraging what you're good at in a slightly different context. So we've covered building on strength, riding trends, outpacing peers, core growth, looking beyond the core into similar areas. What about geography? Does it matter where you succeed first?
That leads directly to rule number 7. Be a local hero.
Win at home first, before you try to conquer the world.
That's exactly it. The research really reinforces this. You absolutely must establish a strong competitive position and prove you can succeed in your home market before seriously trying to expand internationally.
Why is that so critical?
Because it's incredibly difficult to achieve sustainable overall growth if your core business isn't actually thriving locally. Your foundation needs to be solid.
Is there data showing the risk if you don't nail it at home first?
Yes. The study found that less than 20% of companies in their sample, companies that had below average operating margins in their local home markets, less than 20% of those managed to outperform their peers overall.
So trying to use international expansion to fix a weak home base,
Yeah.
it just usually doesn't work.
Doesn't work for most companies, no. The data is pretty clear on that.
That makes a lot of intuitive sense, actually. You need that solid foundation before you build outwards. Any company examples in the source where this played out?
They mentioned an air conditioning manufacturer. Initially, they struggled, slow growth at home.
Yeah.
So they tried aggressive international expansion as the fix.
Hmm.
Wasn't successful. Their fortunes only really changed when they refocused, fixed their core operations, improved their market position in their home region first.
Ah,
Once that base was strong, then they successfully expanded into big markets like North America and China and got much better results.
okay, that's a perfect bridge to Rule 8 then.
Which is, go global if you can beat local.
So once you are strong at home, then international expansion becomes a powerful growth tool.
Precisely. The research shows that roughly half, about 50%, of the total revenue growth in the entire sample actually came from outside companies' home geographies.
Half the growth was international.
Wow. Yeah. And for the companies that did expand internationally, they gained, on average, 1.9 percentage points more annual excess TSR compared to their industry peers who just stayed focused on their home market.
Okay, but here's where it gets really interesting, right? Because you stress needing that strong home base first. The source had that fascinating chart showing TSR based on both home growth and international expansion.
That chart is absolutely critical. It lays it out perfectly.
What did it show?
It reveals that the highest excess TSR gain, a really significant 4.0 percentage points, came from companies that were growing fast in their home region, and they also expanded internationally. That combination was golden.
The best of both worlds.
Exactly. But on the flip side, companies that grew slowly at home but still went ahead and expanded internationally, they actually saw negative excess TSR, averaging minus zero point 0.7 percentage points.
So expanding actually hurt them if the home base was weak.
That's what the data shows. It empirically confirms that global expansion is a powerful accelerant only when you have a robust local engine powering it. Trying to export a weak business model. It's just a recipe for destroying value.
That data is incredibly clear. Don't try to outrun your problems at home by going global. It just makes them worse. And the example they gave.
The source mentions a European manufacturer. They made agricultural and municipal vehicles. They built a very strong, very defensible market position in their home region first.
Okay.
And leveraging that established strength, that operational excellence, allowed them to generate market-beating returns when they systematically ventured abroad.
It makes sense. Okay, so we've covered internal strength, external trends, relative performance, core focus, adjacent moves, and smart geography. What about growth through M&A, buying other companies?
That brings us to rule number 9. Acquire programmatically.
Programmatically, what does that mean? Not just doing one big splashy deal?
Exactly that. The research specifically looked at different M&A approaches, and it found that companies engaging in programmatic acquisitions, meaning a disciplined series of smaller deals over time, they significantly outperformed both companies that relied only on organic growth and, importantly, those that went for the big headline-grabbing big bang or one very large acquisition strategy.
The data on this is pretty striking, isn't it? It really seems to challenge that common idea that you need a mega merger to transform your business.
It absolutely does. The numbers are stark. Programmatic acquirers, they have the highest revenue CAGR, compound annual growth rate, at 5.8%. Got the highest excess TSR at 2.1%.
Better growth, better returns.
Right. Now contrast that with organic growers, 3.8% CAGR, 0% excess TSR. Okay. Then other M&A strategies lumped together, 3.2% CBGR minus 0.2% excess TSR.
Clearly negative returns there.
And then the large deal acquirers, a really low 1.4% CAGR and a negative 1.9% excess TSR.
Negative TSR for the big deals, on average. And positive for a series of smaller ones. Why? Why is programmatic M&A so much more effective, according to the research? What's the logic?
Well, the source suggests it boils down to capability building and risk management.
How so?
Programmatic M&A forces companies to get good at the whole M&A process. Integrating strategy, sourcing deals, doing thorough due diligence, handling post-merger integration. It becomes a repeatable, disciplined operational capability.
Like building a muscle.
Exactly. It builds expertise and reduces the chance of making one massive, catastrophic error. And secondly, smaller deals are just typically easier to digest, easier to integrate culturally, operationally. They pose less risk if one specific deal doesn't pan out perfectly.
Right.
So it's a strategy that allows companies to consolidate fragmented markets more systematically, build value incrementally, rather than placing one giant high-stakes bet.
That makes a ton of sense. It's about process, discipline, learning, not just sheer size. Okay, that brings us to the 10th and final rule. And this one, it feels completely counterintuitive at first glance. It's okay to shrink to grow.
It does sound odd, doesn't it? after all this talk about adding and expanding. But the research reveals that strategically subtracting can also be a path to value-creating growth,
Yeah.
particularly for companies whose growth has been maybe inconsistent. This rule basically means periodically pruning your portfolio, divesting assets or business units that are underperforming or don't fit the strategy anymore, or maybe just suck up too much management attention for the value they provide.
But how does getting rid of parts of your business actually help you grow or create value? It feels backward.
Well, it helps by focusing the company's resources, both capital and precious management time, on the areas where it does have a competitive advantage and a real growth potential. It ties back to Rule 1, competitive advantage, and Rule 4, supercharging the core. Divesting those poor performers removes a drag on overall results.
Yeah.
And it frees up capital that can then be reinvested much more effectively, following the other rules we've discussed, maybe into those similar adjacencies, or strengthening the core, or funding those programmatic acquisitions.
So you're cutting off the dead weight to let the healthy parts really thrive. The source's data on different growth patterns really makes this clear, doesn't it?
Oh, absolutely. That chart comparing growth patterns is fascinating. Consistent growers, they have the highest excess TSR, a really remarkable 7%.
It's okay, top performers.
Right behind them, the shrink-to-grow companies, defined as those that divested assets over maybe 1 or 2 years but were otherwise consistent growers. They still achieved a very strong 4% excess TSR.
4% is still really good, better than
The inconsistent growers, who averaged a negative 1% TSR. And much better than the large deal acquirers, who were at negative 2% TSR.
Wow. That data is incredibly compelling. Actively selling off underperformers is significantly better for value creation than just holding on to everything, especially if your growth track record isn't amazing. That shrink to grow idea is a powerful and maybe surprising takeaway.
It really is. It forces discipline in managing the portfolio
Right.
and reinforces that value isn't just about getting bigger, it's about optimizing the mix of businesses you actually run.
Wow. Okay, that is a tremendous amount to absorb. 10 distinct rules, all anchored in this deep empirical data from thousands of global companies over 15 years. It really reframes the whole idea of growth, doesn't it? It's not just one goal, but the result of mastering the set of specific, interconnected strategies about how and where you choose to compete and expand.
Absolutely. The research provides this rigorous, data-backed blueprint. It emphasizes building on that strong foundation, that competitive advantage, Rule 1, strategically positioning for the big market tailwinds, Rule 2, making sure you're outpacing your peers, even in tough sectors, Rule 3. It shows the critical importance of strengthening and leveraging your core business, Rule 4, and then expanding smartly into similar adjacent areas where you can actually get those synergies, Rules 5 and 6.
And then mastering your home market first, building the strength you need before you try successful international expansion, Rules 7 and 8. Using that disciplined, repeatable process for acquisitions instead of just chasing the one big deal, Rule 9.
Exactly.
And finally, having the courage and the discipline to shed the underperforming assets, to focus your resources where they'll have the biggest impact, Rule 10.
They really form a holistic system, you see. They all connect.
So what does this all mean for you listening right now? Well, whether you're working inside a big company or investing in them, maybe running your own business, or even if you're just deeply curious about how economic value truly gets created, these 10 rules reveal the underlying dynamics, based on hard evidence, not just anecdotes or theory. They give you a framework for understanding why some companies thrive while others struggle, going way beyond just the simple headlines or the top-line revenue numbers. These are the kinds of insights that can help you feel genuinely well-informed and maybe even spot patterns in corporate strategy and performance that others might miss.
And, as we wrap up this deep dive, the research leaves us with a really provocative final thought, something that kind of echoes through all these rules. Remember that stat I mentioned way back at the beginning?
The 8%.
Exactly. Only 8% of the top 5,000 global companies they studied managed to master all 10 of these rules. And fewer than half mastered even 5.
Yeah, staggering.
So it raises this really important question. If the empirical evidence points so clearly to what actually works for value-creating growth, what makes it so incredibly challenging for even the world's largest, most sophisticated companies to consistently execute on these fundamental principles?
What's stopping them?
Right. Is it just the sheer complexity of running these huge organizations? Is it deep-seated cultural inertia? We've always done it this way. Is it the difficulty of getting leadership truly aligned? Or is it something else entirely that prevents them from consistently following this, proven playbook?
That is a fascinating question to chew on. Thank you for joining us on this deep dive today, and thank you for providing the source material that made this whole exploration possible.
My pleasure.
As you think about this, maybe consider which of these 10 rules feels most intuitive to you, and maybe which one seems like it would be the absolute hardest for a large, established organization to actually implement consistently day in, day out.
Good question to ponder.
Until next time, keep digging deeper.